Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Anil Hansjee. Anil is a general partner at Fabric, a leading UK-based blockchain VC. Prior to Fabric, Anil ran corporate development EMEA at Google and then led PayPal Ventures in the region. He has tremendous experience investing in fintech and payments at the venture, strategic, and angel levels. In this conversation, we dive deep into payments, covering the existing legacy stack, initial waves of fintech innovation, and more recent blockchain and stablecoin-based approaches to improving global commerce. Anil is incredibly experienced, thoughtful, and articulate, which made for a fantastic conversation. Thank you very much for joining us today. Please welcome Anil Hansjee. Anil Hansjee, welcome to Rebank.
Thanks, Will. Great to be here. Excited to talk payments.
Well, it's great to connect with you.
It's been a while, hasn't it, since we last met in London. You've gone on to bigger and better things.
You too. I mean, that must have been, 2017, 2018 maybe? You were running corporate development, I think, for PayPal at the time.
That's right. Yeah, I just joined PayPal, ran Corp Dev EMEA for them, and was starting to build PayPal Ventures as well with some US colleagues.
And I was building Alica. And here we are now, both, broadly speaking, in the blockchain crypto world. You're a general partner at Fabric now.
But still in the same industry of payments and financial services. We love it, don't we? So
Totally. Honestly, I mean, I feel like that's lost on a lot of people still at this stage, that what we're doing in crypto and blockchain is actually what we were doing, 6-7 years ago in fintech. It's just building new rails, new infrastructure for finance to make it better. Finance and many other things, I guess.
Yeah, spot on. I think there's a lot of overlap in some of the same trends and innovations on the surface level, and in making financial services, payments better, less costly, more efficient, et cetera, et cetera. But then there's also some more fundamental changes because we're ripping out and replacing rails.
So maybe if we come at it from that starting point, right? So you have been innovating in payments now for many years. What's so interesting about payments, and why are you still focused on payments now?
Yeah, and actually it goes many years before I met you as well. I mean, effectively, I've been in payments since 2011 when I was at Google, and first started working with guys like Osama Bidier, who was ex-PayPal at the time and ran payments at Google when he was launching Google Wallet. Since then, it's just been an evolution, an endless wave of evolution and disruption in this industry. It still excites me because of many attributes. I think let's run through a few that come to mind. Number one, it's big. And investors like big TAMs, right? Recently, I was looking at some JP Morgan research that was a few years old, but was talking about something like $54 trillion of global payment volume. And let's say that again, 54 trillion. Now, this is like spread across super apps like the Chinese super apps, or e-commerce, wallet payments, which include crypto, loyalty wallets, embedded payments, banking as a service, remittance and trade payments. But nonetheless, I mean, there's all of that. So payments is in itself big, but it's also multifaceted, right? Each of those subsectors have different drivers and attack vectors, constant flow of startups coming from that. It's such an important industry as well. And VCs like to be the center of big problems, the center of the world, center of the economy. It's a hugely important policy tool for governments. So much attention on the regulatory side of things. It's a political tool. We've seen that in blocking SWIFT in Russia, for example. And it's just not going away, right? I mean, it's fundamental for making transactions work and settling trade. And, we have a human instinct to kind of continue to truck and barter, and that's not going away. Another reason is it's data rich, right? And data is the new oil. We know that too. There's a transaction element of a payment, where the actual transmission of funds. And then there's the data that corresponds to that. And that information could be around who you're paying, how much, which accounts, which intermediaries, why, the loyalty behind it, et cetera, et cetera. That information flow could be separable from the flow of funds, which is critical for many solutions such as loyalty or KYC. You've had a number of exits as well, and also VCs like exits, right? I was at the heart of several at PayPal. The other thing that's interesting is we're just not investing in payments companies per se. We're investing in companies that leverage payments too. So there's a bigger pool to fish in. What I mean by that are companies that embrace and use embedded payments. Think Uber and Amazon. They're not payments companies, but they are, and they're taking their cut of merchant of record fees. Another reason is it's a complicated space. It's deceptively complicated, actually. There are many pain points, and we can lose sight of the complication because in the Western world, it's really not that difficult to make a payment. But actually, when you rip away that layer, it's multifaceted, multi-party, depends on where you transact, which payment method, what you're buying, which market you're in. There are many wedges to play into. Another reason is there's a standard and accepted business model and margin that you can eat into. And again, VCs like disruption of business model, like think the free model where I guess tech advertisers where your attention and your data is the prize, not the fee. And there's just continued to be so much innovation because of all of this, whether that's business models like buy now, pay later, or opening up core infrastructure like open banking, or UX innovations like biometrics or mobile payments or fraud detection and security. And there's just so much more to come. But I do think that pivoting onto the blockchain question, I think that a lot of these things that I've been talking about have been largely addressing surface problems, aggregation, user experience, orchestration, process improving, removing fraud, reducing costs, providing payments as a service as opposed to needing to develop it yourself. Effectively, all of this is because the underlying rails have been the same. And so the rules of the game have been the same. Yes, there might be some large-scale governmental changes happening in real-time gross settlement networks for wholesale settlement central banks, but those are sort of cumbersome and not driven by private initiatives. And that's really why I find what's happening in blockchain payments super powerful, right? Because it's one of the first opportunities of outside-in rip and replace of infrastructure where the rules can be rewritten, and it's introducing peer-to-peer settlement versus centralized. We can talk a little bit about the stuff I see and what I get excited about there, but that's the premise why I've liked payments for all of those years, but now we're coming on to something even bigger and better.
I have to admit, I was expecting like a 2 or 3 sentence answer why payments is so interesting. you actually answered a few of my questions all at once, because a question I was going to kind of follow up with was fintech has been building around payments since, you said 2011 you first got into payments. At that point, people were already building fintech companies around payments. And here we are 13 years later, and we're still talking about payments as one of the biggest opportunities in fintech, startups, or innovation applied to finance. And so the question that I was going to ask you was like, all right, so if we've been working on this for 13 years, why is it still such a big opportunity? Maybe in part you answered that through the discussion of the complexity. Do you have any further thoughts on that question?
In 2010, the quickest way to move money from London and New York was get on a plane and take it. So that's the context of where we started, right? So we've moved a tremendous amount, but if that's your starting point, there's no wonder that we're still innovating. So it is about the richness of payment. Like I mentioned, so many different categories from e-commerce to trade payments to remittances, embedded payments. It's a very rich tapestry and very complex in each of those verticals, sub-verticals. And they're all built on multiple layers that have been put in place over years, way before I got into payments, right? Real legacy systems. And each of those layers have not reinvented the prior layer. They're just simply plastered on top like a layer cake, introducing more wedges for problems, pain points, costs, intermediaries, etc., that just have existed there, and processes and user experiences that are broken. And so it has really been about re-engineering a lot of those, not so much at the fundamental rail level, but all of the layer cakes that have been put on top. And that's what takes time to re-engineer.
Maybe pivoting a little bit and thinking about Fabric. Tell us a little bit about the high-level thesis and then how your payments focus fits into that.
Fabric has been a very successful early mover in venture capital in, broadly speaking, Web3, and has been around since 2016 when my partners Richard and Max founded it. And I was lucky enough to know these gentlemen through private angel investing that, we'd done together before that in more traditional fintech and e-commerce. Many companies, successful companies like Wise and WageStream and Banked and companies like this. And so we got to know them quite well. And I was an investor in their fund, and they had been really a first mover, very thematically driven investor in the Web3 space, everything from gaming to core infrastructure to DeFi and beyond. And I do think that what I added was an understanding of the payments industry and that sort of interface between these liquidity pools that may exist off chain and how they could benefit coming on chain. And that's why it was sort of a nice merger between us. And so I left PayPal in 2021 and joined them for their second fund as a partner. And within Fabric today, the future of finance, I guess, or payments, are separate and distinct from decentralized finance that may happen, which is more around capital markets on chain, has become quite an important thesis for us, not just because of me, however. We also have a chairman that is on the board of a European regulated regional systemic bank launching a stablecoin. We have a venture partner who's ex-Visa and founder of YoYo Wallet and is now doing Silk as a point of sale merchant acceptance, including crypto. We have advisors in personal capacity who represent themselves, but are from Visa, Gnosis Pay, Google Wallet, etc. And the fund itself is backed by the European Investment Bank, their fund, EIF. So it is a high focus vertical for us, and I think a very promising one. And we've done a number of deals, both in the stablecoin space, in the quite disruptive new payment methods on chain space, and a lot in that sort of Web 2.5 space that is the interface between these liquidity pools like on and off ramping or stablecoin liquidity or banking as a service for VASPs or cards as a service for unhosted wallets, and the wallets themselves, so like Argent, Ledger, MetaMask, Safe, those kind of things. So I think it's super important. And even if we invested outside of payments, there are many themes that we invest in that benefit payments. So themes in and around loyalty, identity, security, scalability of chains are all there to make payments work better on chain. So a lot of interrelation.
Yeah. One of the reasons I love talking with Web3 investors at this stage, right? It's such I guess in most senses, a nascent space. And the terminology is constantly evolving, but Web3, aka blockchain, aka crypto, there are differences there. Because everyone has a different lens. If your goal is to raise money and invest for return, there are many different strategies. One is simply a quote unquote liquid token strategy, a lot of which is basically arbitraging inefficient markets and or the regulatory status of some of these things to basically do things in tokens that you wouldn't be able to in other types of listed securities. More of a hedge fund type model in a lot of ways. Then there are other investors that are really looking to follow the narratives, follow the trends, see where the capital is flowing on chain and make short-term gains by investing in projects that are going to have immediate resonance, immediate success among a small, by relative standards, existing pool of on-chain activity. And then there's a third and even longer-term view, which is this is new infrastructure that's ultimately going to power various parts of the economy, from finance to commerce to ownership, both on and offline. And then in investing in tooling or infrastructure or companies that are building toward that ultimate vision. And at the same time, as an investor, you are very much being evaluated based on the returns that you generate. And sure, as a VC, maybe you have like a 7 to 10 year time frame to deliver those returns. But the faster you can show performance, the better, given the economics of the business. So I wonder how you and Fabric think about the broader investment opportunity and dynamics of generating return on capital in such a nascent and fast evolving space?
I think you've had a lot of discussions with VCs in this space because you nailed it really in terms of segmenting. I would say three types of categories there. Our starting point is where we come from, and we've all been traditional venture capitalists. The three of us, the three partners, and that's what we know best. And I think you should execute on what you know best, which is sort of long-term fundamental change in infrastructure. And so we have this quite traditional venture capital model. However, we operate in a world where those other business models, let's call them, exist. Sometimes we have hedge fund investors in our fund who particularly are interested in where their next token's coming from for their deal flow. But sometimes we need to be able to act on those opportunities ourselves directly if we feel that they are in line and in tune with our main objectives. And so, clearly a lot of equity deals we do will have token warrants associated. Sometimes we, on the back of our relationships in the industry, have access to liquid treasury tokens at discounts based on the value we add to a project and or our relationship with the project. And sometimes we believe very strongly that even something like a meme coin can have a very valuable impact for projects doing the marketing, for example. So I think we can play in all of those spaces. And luckily, we've managed to negotiate some level of flexibility in our terms with our delightful LPs to be able to have that. But we have to stick to what our core is, and then we operate around the periphery to extend that core and take advantage of these other opportunities, given the industry we're in and our understanding of that industry, to improve on liquidity and deliver returns and DPI on a slightly more advantageous benefit for our LPs.
Yeah. So maybe we can apply some of those frameworks to blockchain payments. So the sort of stuff that you're looking at every day and the investments that you're making. At this stage, how would you describe the maturity of the blockchain payment space and interesting segments of it now? And then maybe we can follow up with the stuff that you expect to ultimately come, but that just isn't happening yet.
Actually, maybe we turn that around and start with the stuff that's very clearly
Sure.
not there yet, because that's what people typically think of when you say payments. So, well, it's not there yet, right? That's the first thing that pops to mind. I do think that, and this is slightly biased maybe because of my background at PayPal, but where it's clearly not happening yet at scale, at least, is real world commerce. Let's not lose sight of the fact that generally emerging tech takes time to get to exponential growth. And even the internet itself took, 7 odd years to reach 100 million people. So I'm, on the one hand, quite pleased that you take something like USDC and you can say, well, look, it's across 15 chains. It's got a thriving developer ecosystem. It's processed $12 trillion. Visa is adopting it. It seems to be gaining escape velocity, but it's not quite there to buy a cup of coffee, which seems quite fundamental. Now, we've invested in companies and worked with companies like Kulipa and Gnosis Pay that are changing, hopefully want to change this with self-custody wallets, with debit cards. There are prepaid cards on Ledger, 1inch, Coinbase. Uptake in commerce, however, is pretty marginal, and it's been mostly in places like luxury watch stores or NFT galleries or some law firms as well, believe it or not. But I'm not surprised, I guess, is the conclusion, given what I just said about how long it takes. And I'm actually enthused, and I'm maybe also enthused a little bit on the bias side because my old alma mater at PayPal, I think, could well play a really interesting role there with their stablecoin. I think we need to realize that PayPal, they have, give or take, 425 million active accounts. And there's a significant closed loop trade in the merchant category, something like 35 million accounts, i.e. small merchants selling to other small merchants, both being PayPal users. Like, why convert from stable to fiat when PayPal can facilitate the trade between them immediately? The funds are stable, and at any time you can off-ramp for real-world bills to pay or salaries to pay. And on top of that, PayPal, stand for all the refunds and chargeback of fraud anyway, right? It just seems to me that those are opportunities for merchant to merchant adoption of the stablecoin of PayPal. And they should be attracted, in theory at least, to that opportunity, given faster settlement of funds. In the commerce world, most people don't really understand that the charges imposed on merchants for their payment acceptance can be up to 3.5%, and in some cases 6% per sale. And not many people, consumers that is, understand that merchants also have to wait 3 days for their funds. And cash flow is the lifeblood of these guys, and small merchants are the lifeblood of many economies. But often the smallest pay 4 times more on average in fees than the largest. These costs are not directly paid by consumers necessarily. They might be, but they certainly feed into higher prices generally in the economy overall. So I think the opportunity with the PayPal stablecoin is really promising, and they could even do much more downstream. I don't have any particular insight here, but they could incentivize merchants and consumers further to use a stablecoin. I mean, the additional income that it must get from the increased balance float that they have and the yield generation opportunities around that could be used, and it could be subsidizing other use cases like the remittance. They just launched it for their Zoom remittance business. And if nothing else, they surely would have a reduced transaction expense pressure because their funding mix will shift away from cards and debits to balances, right? So I think net, it's a very interesting move by them, and one that, given their scale, has the opportunity to really push real world commerce through stablecoins. But it's clearly not there yet. So that's why I wanted to start with that, because I think most people, when you say payments, think real world commerce. On the other hand, if we want to move to where I think it is interesting and where it is happening at scale, for me, there are two really super interesting areas where pain points from traditional payments exist so high that simply they are sort of the low hanging fruit. And the two areas for me that we can double click on are, one is gaming and digital assets, and the other is more broadly emerging markets. And it's actually no surprise that the PayPal stablecoin has seen an earlier uptick in the digital gaming market. And clearly in that market, there are traditionally higher card rejection rates, similar to other high risk industries. And it's also no surprise that PayPal has partnered with one of our portfolio companies, Yellow Card, to provide their stablecoin through Yellow Card into emerging markets where USD liquidity is restricted and transaction fees are stifling. So it might be worth double clicking on either or both of those use cases in more detail, but I see scale adoption in both of those use cases.
Do you want to go a little bit deeper into the gaming use case to start?
So what's interesting as an example is that we have another portfolio company called SoRare. There's around 5 odd million users across 180 countries buying and selling different rarities of NFTs of sports players. And there's a game construct around that. And they do 150 million odd GMV. So it's very decent for a game. We have another portfolio company called Immutable, which has an NFT order book platform for secondary trading. Earlier stage for multiple games, not just a single game. They're doing around $25 million per month in primary sales. What's interesting there is there's a pipeline of like 300 games building on Immutable now, 40 of which go live. So we're just at the very early stages of this. And so what I think is interesting is that we just don't need to be fixated on payments only being for coffee or a real world asset. If I stream a movie, that's a payment. If I play an online game, that's a payment. If I want to buy an in-game NFT, I need to pay. It's a real payment. So what's interesting, however, is they abstract this complexity away from their users. And I think that's the critical thing in gaming, because most gamers are not on-chain degens. 80 to 90% of their players, and SoRare, for example, don't know, well, they may know what crypto is, but they don't really care crypto. The problem is, while most non-crypto games have an extremely easy system of purchasing in-game credits, which effectively it's usually via whatever payment store provider, Apple or Google, a SoRare user would have to go to an external crypto exchange platform, and not to mention creating a wallet in the first place. It's basically a horrible user experience that leads to lower engagement, a lot of additional support. It just wouldn't work. And even if you introduce something like a Stripe, As soon as you start playing So Rare, you realize that it's actually much more meaningful to pre-fund your account before bidding and collecting. So sort of at point of sale checkout solutions don't really work. Add to that, being a non-crypto native firm doesn't really understand the fraud management on crypto and has a lower acceptance rates. So Rare, interestingly, works with a company, another portfolio company of ours called Ramp.network. Ramp basically creates a smart contract-based address in the background for the user without them knowing, and Ramp allows for an API to top up instantly without ever leaving the app of So Rare or giving data to third parties. Effectively, also solves like 100% chargeback protection. It basically means that Ramp enables this unified experience of onboarding whenever the user wants, and it improves the top line by reducing drop off with great user experience, and then reduces the cost of the bottom line through fraud. So, you find that even in complex situations that there are solutions for that. I wish it was less complex, but even so, you've got great scaled examples working through the collaboration of different parties to make a high risk industry work properly.
So how does the user get the money into the game in the first place?
It's effectively an API based on Ramp.
The user pays with a credit card, and it ends up basically in this digital asset balance, this crypto balance provided by the Ramp.
Exactly.
Ramp
and you don't need to know that you have a wallet. You don't need to know you're buying NFTs. You just think you're buying player cards, which are rare. So I think in general, gaming is working, and there's more to come on that. I think we're at the very early stages, as I was indicating with Immutable. So why is gaming, just to re-emphasize that? Because as I was mentioning before, digital gaming is a high-risk industry in the sense that typically card acceptance rates are lower. So having specialized solutions like Ramp provide solve some of that problem that on-chain gaming has. The other use case that's doing well is another really low-hanging fruit in emerging markets. You and I have bank accounts, allows you to do international dollar payments. We have a credit card that can broadly be used everywhere. We have access to, broadly speaking, any ATM in the world. The vast majority of the people around the world just don't have that. The stable coins, come in and give people access to the US dollar outside of traditional banking systems. And you cast your eye to sub-Saharan Africa as an example, 65% of the people there are either unbanked or they suffer from extracting fees in remitting what is, I think, key funds for their survival. Like the average cost of, I remember reading something like sending $200 a few years ago in Tanzania was around 27%. It's nuts. And yes, there are fintechs that have been addressing remittances for a number of years now, and fees are falling. But fundamentally, the infrastructure of the continent hasn't changed at the bottom level. It's basically built on a quasi-colonial payment framework where around 80% of the cross-border payments originating from African banks are actually processed offshore in Europe or the US. And that hasn't changed despite all of the cluster that's been put on, an improvement of other processes and UX. And that translates to higher costs and processing times that just, sometimes is weeks, by the way, and won't magically disappear. And those that can afford it the least end up paying the most. Then a lot of people say to me, well, what about mobile banking? I don't know, M-Pesa or something like this. And yes, I mean, it's fantastic what it's done, but it's only partially a solution. I mean, the latest stats that I read were, I don't know, from the World Bank, I think it was, that 30% of the population in that same region in sub-Saharan Africa use the internet. So what about 70-odd% that don't? I mean, it's been a game changer, mobile banking, but they also still don't get the perks that we take for granted, like earning interest on bank savings or building up a credit score on history of spending. And then look at businesses, right? In many markets, the small businesses are the bedrock of the economies. So let's take an importer of chemicals or clothes sent from, say, Asia to Africa. They struggle to live up to demand. I mean, currency controls or other limitations or access to internationally recognized currencies, like, say, US dollars, are simply restricted. So how do they help grow their economies when they can't access the US dollars to make that trade? It's no surprise that crypto plays a role here for trustlessness, decentralization, inability for governments to change the rules. It's actually a much stabler source of store of value and a medium of exchange than their domestic currencies are. It's no surprise that remittances, use of stables is huge in that area. And what I've just said about sub-Saharan Africa applies to Vietnam, Philippines, Ukraine, India, Pakistan, Indonesia, big economies. We have a business there called Yellow Card I mentioned before. I mean, they're doing 2 billion in annual volume there using stable coins, and they're fully regulated across multiple markets. And they serve other fintechs building on top of them through their APIs. So I think that's a scaled use case as
Yeah.
well.
Wow. All right. So, conscious of time, maybe there's a good opportunity to naturally transition to a final question, which is around some of the future areas that you think are most exciting. We've touched on a lot already. Be interested in any further thoughts you have. What piques your interest as you look forward?
So just building on what we were talking about there before, I mean, clearly there's much more friction to remove, right? Let's strive for something that we call no friction finance, whether that's friction in speed, transparency, or costs, or who you enable to participate in terms of inclusion. And that no friction finance can be achieved through rip and replace of the legacy rails. Without a doubt, we still have plenty there. Just capital markets, for example, settlement T+3 or merchant funding, removing that time lag. There's many more opportunities. And so we do look at that. If I take it one step further, though, I think what's more exciting for me are the payment flows that we simply have not been able to execute on using the current layer cake of legacy payment rails. And in addition, what we could do with the rich data that the payment itself was a means to end in delivering, the data that I mentioned before that was associated. So fundamentally, I think those two things are about the programmability of payments and the use of data in those payments. Just some examples, probably a little bit more futuristic, but I think we're seeing businesses address these in early stages. A US dollar suddenly can go where traditional payment networks have not been able to. For example, microtransactions might actually work because now we can charge 0.00001 euro cent for the content, or tipping a YouTube streamer or something like that. It's simply impossible on TradFi rails. So it opens up new types of payments. Payments themselves could be completely confidential, but with some auditability or some controls on them. So there are limits built in through automation and programmability. There are limits to which wallets a payment could go to, how or when, or it could be frozen for regulatory purposes, or the funds could be controlled in how they're distributed. Loads of scandals in the US around the COVID-19 distributions, lost control of who they went to, how they were used. All of that stuff can be done. The payments can be composable with the underlying data so that you can actually build in more interesting loyalty and reward programs that are connected directly with the payment. Super exciting. We've got an investment in Superfluid, which is about streaming payments. So we can change the notion of what is a payment. It's not a discrete transaction. It's instead a stream that's real time and ongoing that continues as long as you consume a service, such as a rental or a salary payment that can be constantly streamed. And then just broadly speaking, better use of smart contracts in payments, right? So you can build in predefined terms and conditions connected to immutably prove specific behaviors, whether it's purchase behaviors or rewards were delivered only where justified, or there's a connection causation loop that's connected between a brand spending on ads and that brand having proven that somebody closed the loop and purchased something. Smart contracts can be set up to immediately pay a supplier on receipt of the goods rather than having to wait for an invoice to be issued and then paid. A lot of these programmatic examples that I think are possible on chain. And for me, that's much more than just no friction finance. For me, it's not even about finance anymore. It's about more than finance. It's beyond finance.
Incredible. Wow, Anil. All right, you've left me with so much to ponder, so much to think about. This is exciting. I can see why 13 years in, you're as focused
strong
and as excited about payments as you were at the beginning. Incredible.
Believe you me, thank you for that. But believe you me, there's also a lot of hurdles and unknowns. And part of the fact is that whether it's regulatory, whether it's chain specific, whether it's political, whether it's simply a matter of time, whether it's a liquidity issue, this stuff doesn't come for free. We have to navigate all of these complexities to find those opportunities. But if it was easy, then everyone would be doing it.
If it were easy, it wouldn't be fun. Anil, thank you so much for making time to connect. This was really a fascinating conversation.
Pleasure. Lovely to speak to you and some good questions. You obviously know the space. Nice to talk to someone who comes from the same world that is looking at some of the same challenges and opportunities.
No, thank you. Thank you. Likewise. Anil Hansjee, thank you very much for joining us today.
Take care. All the best.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.